Cryptocurrency is not an asset class. That was according to a report by Goldman Sachs about a year ago, and they seemed pretty conclusive in their assertion. However, it seems as if GS is having second thoughts. It seems that despite the recent market turbulence, it is backtracking on those claims. That's according to the most recent report to come from its global research team, a report that takes a surprisingly in-depth look at the crypto markets. Today, I'm going to break that report down. I'll be going over some of the most important points and explaining exactly what they mean. So, if you're concerned about these crypto markets, this is a vid you can't afford to miss. And now, I have some news, I'll say it clear, so you're the wiser. You're about to hear my views, but I am no financial advisor. To educate and entertain is the sermon here in Crypto Church. So please, be sure you do your own research. Now, with that bombshell out of the way, I would like to welcome any new viewers to the channel. My name is Guy, and that sound you can hear is Frank Sinatra turning in his grave. Over here at the Bureau, I'm on a mission to bring you the highest quality crypto content known to man. I'm talking news, reviews, coin overviews, and market moves. It's all on my YouTube. Sound interesting? Well, gently direct your cursor over to that subscribe button and give it a click. You may also want to turn on all those notifications to make sure you're not missing a single video. Don't let them fall through the cracks. And finally, behold these wonderful timestamps in the video timeline. Those are there purely for your convenience to jump around should you so wish, although I would highly recommend watching this one the whole way through. Alrighty, let's dive in. Let's start with that report that Goldman Sachs released last year. It was their global macroeconomic outlook for the year and was released on the 27th of May, just after the COVID-inspired lockdowns had caused economic mayhem on the markets. The report was quite comprehensive and covered a number of different topics and investing themes. The part that talked about cryptocurrency was only tacked on at the end and made up less than 5% of the entire piece. Despite this, though, I was surprised that the folks at Goldman even considered covering the asset class. It shows that it was something that they couldn't ignore anymore. However, the report was not too flattering. They claimed that Bitcoin is not an asset class because of the following characteristics: no cash flows, no earnings, unstable correlations, high volatility, and so on and so on. They claimed that the only reason that Bitcoin has value is because other people are willing to buy it. Now, I don't really have the time to dispute each of these claims right now, but it's clear that they had a narrative to push at the time. You only need to take a look at the second slide after that. They start talking about the illicit activity that Bitcoin and crypto has been used for. Everything from Ponzi schemes to ransomware to money laundering. Sorry. It didn't stop there, of course. They just had to cover the fact that there have been billions lost in hacks of exchanges and other protocols. And of course, no FUD piece on crypto is complete without comparing Bitcoin to tulip mania. That is exactly what they did on this slide over here, where they compare the rally of Bitcoin to previous periods of market euphoria. So, it's quite clear that this piece was not at all flattering. It drove the news cycle for a few days as people were digesting its implications. Well, that report was a year ago, and this was at a time when Bitcoin was at 9,000. Things have changed considerably since then, including Goldman Sachs' view on it. And so that brings me on to their latest report. Right off the bat, the report addresses their previous statement on Bitcoin not being an asset class. The top of the report is titled, Crypto, a New Asset Class. And so they've made it clear that despite all of the perceived challenges that Bitcoin faces, it is still favored by institutions, including a bank called Goldman. Oh, right, that's them. Yep. Goldman has recently been offering its high net worth clients exposure to Bitcoin instruments. Hard to justify structuring products for these investors if you thought that they were akin to a tulip, but I digress. Back to the report. They start off by interviewing well-known permabull Mike Novogratz of Galaxy Digital. He claims that as long as the macro trends we've seen continue, the institutional adoption we've seen will likely continue too. Fun fact, Mike Novogratz used to be a partner at Goldman until he was forced out. He started his own macro hedge fund and started heavily investing in crypto. A pretty good trade if you ask me. Zach Pandel, who is one of Goldman's top strategists, agrees with Novogratz. He states that, quote, Bitcoin's potential for widespread social adoption, given its strong brand on top of its other properties, such as security, privacy, transferability, and the fact that it's digital, makes it a plausible store of value for future generations. He also thinks that they should view it as an alternative macro asset to gold. I've made similar arguments most recently in my video on Bitcoin Global Macro. Here you actually have a handy chart which further illustrates that point. It is the graph that shows the performance of Bitcoin and gold in the wake of the FOMC announcement. Now, Novogratz also thinks that some of the most exciting growth in the crypto space is likely to come from DeFi, non-fungible tokens, and payments, all of which are currently being built on Ethereum. Another positive Ether argument at GS came from their global head of commodities research, Jeff Curry. He claims that in order for cryptocurrencies to be a strong store of value, they have to have use cases beyond just price speculation. This can then temper the volatility and make them hold value that much better. As I've covered on numerous occasions, the Ethereum blockchain is one of the most versatile around. The more dApps that are built on it, the more use cases there are for ETH, and the less its price swings about like an orangutan in the Malaysian rainforest. Another senior strategist at GS, Christian Müller-Glissman, found that even a small allocation to Bitcoin, 5% in a standard 60-40 equity bond portfolio, would have led to strong outperformance. Here you have the graph that shows that performance since 2012. If you wanted to get a sense of how the performance would have been had you allocated more of it towards Bitcoin, then you have this handy table over here. Christian states that the reason for this comes down to the relative lack of correlation that Bitcoin has with those traditional assets, although this correlation has picked up quite a bit over the year. One of the most interesting people that they interviewed was, of course, Matthew McDermott, their recently appointed head of digital assets. He explains exactly why Goldman has changed its tune, and that comes down to client demand. When your hedge fund, asset managers, and high net worth clients want some of that crypto exposure, you have to listen. And in a way, this report is reasonable evidence to point to the fact that GS is indeed listening. Moving on though, we have some high-level charts that explain how things look in the crypto markets. Firstly, they have this chart over here, which has shown just how well particular assets have performed this year. Although I'm not surprised to see the surge in ETH, that Goldman Sachs Commodities Index of Energy is surprising. It is up even more than Bitcoin. Energy prices have grown by more than Bitcoin year to date. These energy costs are what are used to drive the economy, and rising prices of the factors of production mean an alarming trend for inflation. This is exactly what I covered in my video on inflation, which you can watch after this video by hitting that link in the top right. Another interesting thing to point out on this chart is the fact that gold, traditionally viewed as an inflation hedge, is actually down on the year. I should also point out that some of the worst performing assets here were government debt. Fancy negative yields on your US Treasuries or German Bunds? Moving on to the next chart, here you have the annualized volatility of Bitcoin and Ether compared to many other assets. As you can see, both of these have been much more volatile than traditional assets. No real surprise there. However, when it comes to risky assets, you also have to take a look at them in conjunction with their returns. To go back to a quote by their multi-asset researcher who claimed that Bitcoin gave attractive risk-adjusted returns. Moreover, this volatility is likely to reduce over time, and that is because of the next chart over here. This shows total activity taking place on the Bitcoin and Ethereum blockchains. Now, the more people that are using the blockchain, it means more utility demand for BTC and ETH. This was exactly the argument that was being made by their commodities researcher, Jeff Curry, when he said that this could lead to a decrease in the volatility of these assets. In the case of ETH, this activity is at all-time highs, for instance. Here we have the total market caps of Bitcoin, ETH, and gold. As you can see, pretty big rallies in 2021 for crypto, but it still pales in comparison to gold. Now, as I've said on multiple occasions, Bitcoin is a better store of long-term value than gold. Its hard-to-find limit at 21 million BTC means that it is the ultimate scarce asset. Now, this final chart is also pretty interesting. It shows the total amount of addresses that are in profit. Despite the recent crash, 70% of all Bitcoin wallets and 85% of all ETH wallets are in profit. I would also like to point out that in the March 2020 crash, this was below 20% for ETH and 50% for Bitcoin, just further evidence of the virtue of the hodl. They then take a bit of a closer look into Bitcoin on this page over here. The first chart goes over the supply metrics of Bitcoin. As you can see, they've shown the 21 million cap as well as the asymptomatically increasing supply schedule. 90% of all coins that will ever exist have been mined. However, they went one step further and included a chart that shows the impact of lost coins on the schedule. As you no doubt know, over 20% of all coins in circulation have been lost. This was either through people who lost their passwords, sent it to a wrong address, or the owner sadly passed away. So, as you can see, the true amount of Bitcoin that is actually available to be purchased is much smaller than that. There is even less available than you think, which further reinforces its safe haven narrative. And further on that scarcity point, here is the amount of inflation that you have in the Bitcoin supply. As you can see, it is constantly decreasing and goes through large falls when there are halving events. The most recent of these was last year in May, where we saw the block reward drop to 6.25 BTC. These halving events are also important if you're an adherent of the stock-to-flow model. I won't go into the details here, but I have linked to the blog post below, which describes it in more detail. Another really interesting chart is this one over here. It shows the estimate of how much of the Bitcoin supply is really liquid at the moment. Over 80% of it is illiquid and is being hodled in cold wallets. Most of the people that hold Bitcoin are doing so for the long term, and the prices that we see today are being driven by trading of only a limited supply of the coins. Further to add to that hodl narrative, you have this chart, which shows the age distribution of these wallets. Only a small percentage of the outstanding wallets are short-term holders. 55% of Bitcoin's supply is in wallets that are a year older, and a further 41% are for those that are between a week and a year. This actually fits in pretty well with the next chart, and this shows the distribution of Bitcoin wallets among size of holdings. Whales hold a much larger percentage of supply than the non-whales, which of course makes sense. Tying that in with the age metric over here, you'll also notice that a lot of the whale wallets over here on the Bitcoin rich list don't have many transactions in and out of them. Whales are more likely to hodl than smaller retail investors. Now, this was all the Bitcoin metrics. How are things looking for Ether? Here is the page where they break down some of the key stats for the Ethereum market. Here they have the Ether supply graph. As you can see, there is no supply cap on ETH, and supply increases at a relatively constant growth rate. Next to that, they have the ETH emission schedule, which shows that it has also been on the decrease the past 4 years. What I do find interesting about these supply stats is that there is no mention here about the impact the EIP 1559 will have on this supply. For those of you that don't know, it's a change to the Ethereum fee auction mechanism that will see gas fees being burned, thereby reducing supply. I've gone into it in much more depth in my Ethereum analysis videos, linked to below if you're interested. The main thing you need to take away from this is that if the ETH network activity is high enough, the fee burns could actually completely counteract protocol inflation. This could actually make ETH deflationary, a much rarer asset indeed. EIP 1559 is slated to be released in Ethereum's London upgrade, which is going to take place in July. So that is something you definitely want to keep an eye on. On to the next graph here, we have the ETH network fees. Now, gas fees have been going crazy recently, and that is because of all the demand that we've been seeing. You only need to take a look at the next graph over here, which shows the number of dApps that have been built on the network. Decentralized finance, or DeFi, has been center stage recently, and developers have been cranking out these protocols and applications at a breakneck pace. It's not only that, but you have to consider that the demand that comes from stablecoin payments and NFTs, both of which have been going crazy recently as well. I should also point out that these high fees are only temporary. The goal of Ethereum is to move to a proof of stake with ETH 2.0. This could actually happen earlier than we think, as the devs have moved the proof of stake merge forward to stage 1 of ETH 2.0. Now, in fact, speaking of ETH 2.0, it's another topic that Jeff Curry covered in his analysis. As he stated, this could significantly increase transaction capacity on the Ethereum network to up to 3,000 transactions per second. However, when ETH 2.0 is fully rolled out, it's entirely possible that through parallel processing on shard chains, we could reach 100,000 transactions per second. For context, Visa processes 65,000 transactions per second, and that is a highly centralized network of Visa servers. Mind-blowing. On to the next chart, we have this over here that shows people are hodling ETH for a shorter time period than Bitcoin. This perhaps makes sense given that the Ethereum network is a lot more functional than Bitcoin, and people are using their ETH in DeFi applications. And speaking of which, you have this chart over here, which shows the amount of ETH that is locked in smart contracts. This is important as funds that are locked up here are not on the open market. That means that there is less ETH available to sell, which could, of course, suppress the price. The final page that I want to look at is this one. It maps the price of Bitcoin through two separate 3 to 4 year periods. The first started in January of 2013 and extended till the end of 2016. And then they look at the period from January of 2017 to May of 2021. Both periods contained a bull and subsequent bear market. However, the real value from these charts is that they have included all the really important events that have occurred during those periods. The first thing that I think we should take away from this is just how similar the charts look. Bitcoin is a highly cyclical asset that goes through the same trends and is driven by many of the same forces. This is particularly the case when it comes to similar FUD news cycles. For example, we're currently going through FUD inspired by moves of the Chinese government. However, back in April of 2014, when Bitcoin was at $500, there were reports that the Chinese central bank would be shutting down the accounts of cryptocurrency traders. This, of course, caused a fall in the price of Bitcoin, but it soon recovered. In 2017, we had more concerns around an ICO ban by China. I remember those days like they were yesterday. And right after this announcement, you see we had a dip. There was further China FUD in January of 2018. Classic. And here we are in May of 2021, where the same FUD fills the air and Bitcoin is off its all-time highs. The point is that a lot of these market moves are predictable. And while the past cannot be used as a predictor of future returns, it often rhymes. The Goldman Report then goes on to break down numerous concepts in crypto. These are actually in a surprising amount of detail, and I encourage you to take a look if you have some time. The point is that this report seems to have been released in order to start legitimizing cryptocurrency as an asset. As mentioned, you had those rumors that the bank was getting ready to offer their wealthy clients exposure to Bitcoin. Then, more recently, you had internal disclosures that Goldman had established a crypto trading desk. This desk had actually already traded 2 kinds of Bitcoin-linked derivatives. So, it's not actual coins on a physical basis, but it's a start. I happen to think that we're likely to hear a lot more from this bank over the coming few months. And as the bank starts feeding at that crypto trough, expect to see many more of these surprisingly bullish reports. Well, that's it for most of the video, chaps and chapettes. Time for a few of Guy's final thoughts. When Goldman came out last year with its assertion that Bitcoin was not an asset class, I knew this view was bound to change. Even if Goldman really held this view about Bitcoin, its clients were chomping at the bit, just dying to gain exposure to one of the most transformative technologies of a generation. They could not ignore their clients' requests, and I think this report was their way of rectifying the inaccurate information they had in said report. Now, I'm glad they chose to do this in a relatively comprehensive way. And it was also really interesting to hear the views from some of their internal team members. It's quite clear that there is a growing narrative within the bank that crypto is much more than just an asset class. As pointed out by Zach Pandel, it's an asset class that is being viewed as a global macro play. An asset that Jeff Curry thinks can have strong use cases beyond just speculation. An asset that Glissman shows could have been a strong portfolio diversifier. And an asset that Matthew McDermott seems excited to pitch to Goldman clients. Now, while I'm sure Satoshi wouldn't approve of the proverbial vampire squid of Wall Street being a proponent of crypto, it is amazing to see how quickly they've shifted their view on it. It seems that the only trend stronger than crypto adoption is the trend of skeptics becoming converts, a trend that won't be slowing down anytime soon. That's it for this video, folks. Now I give the stage over to you. So, what do you guys think of Goldman's abrupt turn? Yay or nay about them entering the crypto markets? Let me know below. I also have to let you in on a little secret. What you see here on YouTube is but only a mere fraction of the content that I share on some of my other social channels. These include my Telegram channel with my daily market analysis, my Twitter with news and channel updates, my Instagram with behind-the-scenes views and memes, my TikTok with my video pipeline and general banter, and finally my email newsletter, my once-weekly view on everything from the hottest coins to exciting trends. I also share a breakdown of my personal portfolio here, and it also comes with a 100% spam-free guarantee. Now, the only official links to those are in my dedicated socials page. You can find that link to in the tippy top of that description box. If it's not on that page, it's not one of mine. Finally, if you guys found this video insightful, then help YouTube help me to help you. Turn that like button blue and don't forget to subscribe. Ping that bell as well for good measure. Now I have an exciting pipeline of videos that you folks cannot afford to miss. It's time to say bye, as this crypto guy has gotta fly.